investors, today we're back for another Model Book stock review episode where a member from the IBD team and I walk you through one of IBD founder William O'Neill's most important stock trades. Not only did the Model Book stocks help O'Neill solidify key trading rules we still put into practice today, but reviewing them will also improve your skills as a trader. And that's what we're all about here, helping you make more money in the stock market. So get ready and let's get to it. Today, IBD's Mike Webster and I will take you back in time to 1962. This was not an easy time. Fears of a possible breakout of World War III affected the markets as geopolitical tensions ran hot. And this played a key part in how this breakout occurred. So why exactly was this considered one of the most important stocks in Bill's legacy?
So Chrysler is probably one of the, in the top five of the most important stocks worth studying. And it was Bill's first big winner. This was right before he did his big trade with Syntex, the birth control pill that really kind of made him his first fortune. But this is what led up to that. And it was really a perfect trade. But before we get into the base itself, look up to the top of the chart, and what you'll see is what the what the Dow was doing back during this time frame. Normally we look at the S&P 500, but during the early 60s we would have looked at the Dow, and you can see that we were in a pretty bad bear market. And one of the things that was going on, amongst others, was the Cuban Missile Crisis. And the Cuban Missile Crisis ended right there as the stock was launching and breaking out of this base. That last little shakeout in the handle of the large cup with handle at the bottom there, that resolved. That's when the Cuban Missile Crisis was resolved. And those of you who are younger or maybe just aren't very familiar with that, I would certainly go and look at some Google it and look at some videos of what was going on. It was a very important time in our country, and frankly, we might not be here today if it didn't end up playing out the way it did.
Basically, when the Cuban Missile Crisis was resolved, the stock market lifted dramatically. This shows a precedent for how you can manage this sort of thing in your own trading. Whenever there's some big issue going on, whether it's an election, whether it's a big Fed move, or a huge earnings announcement from a key stock that might impact the overall market, see what the reaction is right after that event has been resolved. Once this risk event is behind you, immediately look to which stocks are bouncing up with the most strength.
And what are the stocks that bounce up the fastest, the quickest, on that very first day? And run your screens of market surge, see what stocks have the highest closing range, the biggest price changes. And those are your stocks that you want to keep in a special list, because they could be your next Chrysler. Because when the Cuban Missile Crisis was over, this launched right up, and right before Bill bought it there at what is a split adjusted 58 and 5/8, which on the chart shows around $15 or so.
An important thing to note on this trade is the base itself. The technical setup was close to picture perfect. The cup was very evenly proportioned, not skewed on one side or the other. Additionally, the power shown on the right side was another key feature.
And again, these are weekly charts. And so where it closes on that Friday is very important. And that hash mark, if that closes in the upper half and really near the highs, that's a sign of accumulation. That all the buyers are in there, and they're getting as much stock as possible going into the weekend, and anyone who is short is covering, and that pushes the stock up near the highs. And that's how a big part of our analysis is the closing range for a week, as well as on a daily or a monthly basis. But Bill O'Neill was a big fan of weekly charts, and that's what he would focus on.
We can identify the character of Chrysler at the time by looking at the right side of this cup with handle base. As it was moving up the right side, most of those weeks were closing at their highs or just off their highs, a sign of power. It's a sign of bigger institutional investors getting into this stock and buying in a big way. Another key aspect that Mike pointed out with Chrysler and other stocks like it that have produced monster moves is that a base within a base has also formed.
So this is a large cup with handle, and in the handle portion, It's actually a double bottom. And you could look at it both ways. You could look at it as a base within a base, or you could just look at it as a separate double bottom and ignore the cup and just look at the prior uptrend to the double bottom. There's not a wrong way to really look at it. Interpreting charts is an art. So no matter how you slice it, your buy point is pretty much in the same general area. And what Bill used on this was he was using what was a split adjusted 58 and 5/8 entry point.
Essentially, what we have is a cup with handle base. The stock breaks out as geopolitical tensions resolve, and it does what we see in so many of our model book stocks. It builds on itself week after week. We see many weeks of steady accumulation as well as shorts getting squeezed and having to cover their losing positions.
You have this thrust up from the bottom of the handle after the Cuban Missile Crisis is resolved. Then it goes through its prior resistance, has a nice breakout on that pivot week, and you can see he had huge volume on that breakout week, which is very important concept, especially on a weekly basis. That weekly volume bar dwarfs everything else on there. That's telling you that everyone's getting into this stock. It's at the top of their list. As soon as the crisis was over, this was their stock that they wanted to go into. And more importantly, it was a stock that anyone who was short wanted to cover. And at the same time, you had a follow through day on the Dow, and you can see that marked up there on October 29th of 62. You had a follow through day.
So you had the chart breaking out, and at the same time, you had your follow through day. All signals were green, and you're buying it as it moves past the buy point of a very nice looking cup with handle. Then the stock managed to simply inch higher for 16 weeks or so in a row. That's a sign of investors accumulating shares consistently for a few months. And the stock never even touches the 10-week line, which is the red line on this chart.
Forms this tiny little flat base. So in the context of that big move out of the cup with handle / double bottom, it just forms this really shallow, I'd almost call it a shelf or a flat base, and then breaks out from there. And you'll notice on there when he marked this up, with that second buy, he wasn't waiting for it to go through to the left side high of the flat base. He was seeing again earlier prior resistance within that flat base and marking that as a buy. And that's an important thing, that what he was doing on here with these markups wasn't necessarily what he was doing in real time. This is the concept of marking up a model book stock is something that Bill took very seriously. And he would mark up all of them, even stocks that he never traded. And he would mark them up like this, like you see in all the stocks in the series. And it's the way that he would have wanted to trade it if he had traded it perfectly. And so a lot of the times you'll see things and it looks a little bit like hindsight, but that's on purpose, because what he's doing is going through there and saying, okay, where would the ideal entry have been and the ideal exit? And in reality, how we would have traded it would have been different.
Now, in the case of Chrysler, Bill actually traded it better than how we marked it up on this chart. But a lot of times for the stocks in this series, that's not going to be the case. Marking up stocks like this is something that he did for his entire career. And that's exactly how he developed his rules and learned from history.
At that buy point, I'm not sure if he was adding to it there, but by studying this, that's exactly where you'd want to add to it, because it's breaking out from your second stage base. And that's kind of a gimme that you want to be adding to it there. And then the next arrow that you have that's marked on here, that's where he was actually selling it. And that was around the June of 1963. And what he was using, and it's not marked on here, is an upper channel line break, which is an offensive sell signal that he would often use. And it's kind of tricky, but you draw a line after it broke out from its cup with handle and connect the different key peaks in there. And as it poked above it there in the June of 63, that's where he was selling it. So the concept is similar to a climax top where the stock is kind of getting ahead of itself.
Basically, at this point, the stock needs to resolve itself and build a new base. And that's exactly what it did there. But once it built the new base and then broke out of that, Bill wasn't buying it back there because he was using the proceeds to fund his next big trade in birth control maker Syntex.
So you can see that he really got the heart of the watermelon. He got it exactly right from the cup with handle, and he sold it offensively and locked in the best gains. But he still marked it up as if he would have gone back in there and bought it back um, out of that cup without handle, which is kind of a tricky pattern to buy because you don't have that corrective phase of the handle and it just shoots right back up into new highs and you've got to buy the stock there. And then it runs up, it has a nice move. You can see the character is slowing down from its original move out of the larger cup, but it's still going at a decent pace. Runs into some stalling that is marked there where you have a pickup in volume, and it really can't get anywhere. And that's when it was kind of running out of gas.
It's at this point you can see that the character of the stock had changed. It was going up at one rate up until that climax or the upper channel break. Then it formed another small base and went back to its original rate of growth. It was still moving up, but at a much slower pace. And at the same time, we can see that the Dow was still ripping higher.
So you can tell that it's kind of, it's not the same stock that it was before. And at the tail end there, the last mark that we have on there, where you have that heavy volume, kind of stalling type of feel, that's what Bill would call that heavy volume without further price progress to the upside. And he used to mark that up and just abbreviate it out. And it was always kind of tricky to understand all of his abbreviations. But at least he spelled it out there. And that's just a sign where you get all this volume coming into the stock, but it's not really moving anywhere. That's where you're selling into that because the character had changed. And anyone who wanted to buy it had already bought it.
Like many of the stocks in this series, Chrysler is no longer an available stock to trade. Back in 2009, Chrysler filed for Chapter 11 bankruptcy protection, and Fiat picked up a majority stake amid the great restructuring in the US automotive industry. Today, the Chrysler brand continues to live on, but it's no longer American. It's part of a European conglomerate called Stellantis, which was founded in 2021. French-Italian group Stellantis also owns Dodge, Jeep, and Maserati. Stellantis trades under STLA on the New York Stock Exchange. This model book stock serves as yet another great example of what can happen when we ready our watch list during a bear market and are ready to pounce on the best opportunities quickly when things start to turn around. Always remember, if you want to succeed as an investor, never forget to look both forwards and backwards in time.